Guardians of money, central banks and monetary policy. Central banks are the cornerstone of a nation's financial system, often seen as the guardians of money. Central banks are the financial guardians of nations. They oversee the monetary system, ensuring that the economy runs smoothly and efficiently. They manage the country's money supply and ensure financial stability. This involves a delicate balance of controlling inflation, fostering economic growth, and maintaining employment levels. One of their key tools is monetary policy. Through this, they can influence economic activity by controlling the cost and availability of money. This involves adjusting interest rates and influencing the amount of money circulating in the economy. By raising or lowering interest rates, they can either encourage borrowing and spending or promote saving and investment. These actions have a ripple effect on currency values. When interest rates change, it can affect the value of the national currency, impacting international trade and investment. Central banks play a crucial role in shaping economic conditions. Their policies can help mitigate economic downturns and curb excessive growth that might lead to inflation. They act independently from governments to make decisions in the best interests of long-term economic stability. This independence is crucial as it allows them to make tough decisions without political pressure. Their decisions impact individuals, businesses, and the global financial system. From the interest rates on mortgages to the stability of global markets, the influence of central banks is far-reaching and profound. The price of money, interest rates, and currency value. Interest rates are the price of money. When a central bank raises interest rates, it becomes more expensive to borrow money. This can attract foreign investment seeking higher returns. The increased demand for the currency strengthens its value. Conversely, lowering interest rates can make a currency less attractive to foreign investors. This can lead to a decrease in the currency's value. Understanding the relationship between interest rates and currency values is fundamental to navigating the financial markets. Policy crossroads when central banks disagree. Central banks around the world don't always move in unison. For example, the US Federal Reserve Fed and the European Central Bank ECB may adopt different monetary policies. These divergences can create significant fluctuations in currency exchange rates. If the Fed raises interest rates while the ECB keeps them low, the US dollar may strengthen against the euro. This is because investors are drawn to the higher returns offered by US investments. Currency traders closely monitor these policy divergences for trading opportunities. Seeking shelter, safe havens in economic storms. During times of global economic uncertainty, investors often seek refuge in safe haven currencies. These currencies are typically associated with stable economies and strong financial systems. Examples include the Swiss franc, CHF, the Japanese yen, JPY, and the US dollar, USD. These currencies are perceived as less risky during turbulent times. Investors flock to them, driving up their value. Understanding the concept of safe haven currencies is essential for navigating volatile market conditions. The Section 5, Economic Ties that Bind China and Currency Impacts. China's economic performance has a significant impact on global currency markets. As a major exporter, China's currency, the yuan, is closely watched. When China's economy thrives, currencies of countries that export heavily to China, such as Australia and New Zealand, tend to benefit. Conversely, a slowdown in China's economy can negatively impact these currencies. This interconnectedness highlights the global nature of currency markets and the influence of major economies. Section 6. Commodities and currencies, a tangled relationship. Commodities and currencies share a complex and intertwined relationship that significantly impacts global economies. Commodity prices play a crucial role in determining the value of certain currencies. The fluctuations in commodity prices can have far-reaching effects on the economic stability of countries that rely heavily on exporting these raw materials. Countries that are major exporters of raw materials such as gold often find their economic health closely tied to the fortunes of these commodities. Iron ore, copper, and agricultural products are other significant commodities that influence the economic landscape of exporting nations. These countries often see their currencies fluctuate in tandem with commodity prices. When commodity prices are high, the value of their currencies tends to rise, reflecting increased revenue and economic strength. For instance, the Australian and Canadian dollars are particularly sensitive to commodity price movements. These nations are rich in natural resources, making their currencies highly responsive to changes in commodity markets. When commodity prices rise, these currencies tend to strengthen. This is because higher commodity prices lead to increased export revenues, boosting the overall economy and investor confidence. Conversely, a decline in commodity prices can weaken these currencies. Lower commodity prices reduce export revenues, which can lead to economic slowdowns and decreased currency value. Understanding this relationship is key for investors and businesses operating in commodity-sensitive markets. By monitoring commodity price trends, they can make more informed decisions and develop strategies to mitigate risks associated with currency fluctuations. The global trade of commodities is a dynamic and ever-changing landscape. The interconnectedness of commodities and currencies underscores the importance of staying informed and adaptable in the face of market changes. Economists and financial analysts continuously study these patterns to predict future movements and advise on economic policies. Their insights help shape the strategies of nations and businesses alike. In conclusion, the relationship between commodities and currencies is a vital aspect of the global economy. Recognizing and understanding this connection can provide a significant advantage in navigating the complexities of international trade and finance. Section 7. Geopolitical shocks, ripples in the currency market. Geopolitical events, such as trade wars, political instability, or military conflicts, can send shockwaves through currency markets. These events create uncertainty and risk aversion among investors. Safe haven currencies, such as the Japanese yen and the Swiss franc, often appreciate in value during such times. Conversely, currencies of countries directly involved in or affected by geopolitical turmoil may depreciate. Traders and investors closely monitor geopolitical developments and their potential impact on currency valuations. Section 8. Safe havens anchors in turbulent times. Safe haven currencies possess certain characteristics that make them attractive during periods of uncertainty. They typically belong to countries with stable political systems, strong economic fundamentals, and sound fiscal policies. These currencies are seen as a store of value and a hedge against risk. Investors flock to safe haven currencies when they anticipate or experience market turbulence. This demand drives up their value, providing a buffer against losses in other asset classes. Section 9. The currency web, a complex interplay. Currency values are influenced by a complex interplay of factors. Central bank policies, interest rate differentials, economic growth prospects, commodity prices, and geopolitical events all contribute to the constant fluctuations in the foreign exchange market. Understanding these interconnected factors is crucial for investors, businesses, and policymakers alike. Navigating the currency market requires careful analysis and a keen awareness of global economic and political developments. Section 10. Conclusion. Navigating the currency landscape. The world of currency markets is dynamic and ever-changing. It is a complex ecosystem where various factors interplay to determine the value of currencies. Central banks play a pivotal role in shaping monetary policy, which directly impacts currency values. Their decisions on interest rates, inflation targets, and other monetary tools can cause significant fluctuations in the currency markets. Factors such as interest rate differentials, economic growth, commodity prices, and geopolitical events all contribute to the complexity of currency movements. Each of these elements can either strengthen or weaken a currency, depending on the circumstances. Understanding these factors is crucial for anyone involved in the currency markets. Economic news, market trends, and financial analyses provide valuable insights that can help predict currency movements. By understanding the forces that drive currency valuations, individuals and businesses can make more informed financial decisions. This knowledge can help in hedging against risks, optimizing investment portfolios, and planning international transactions. Whether it's investing, trading, or simply managing international transactions, a grasp of currency dynamics is essential in today's interconnected world. With the right knowledge and tools, navigating the currency landscape becomes a strategic advantage, enabling better financial outcomes and more robust economic planning.